somebody was calling me very rudely in the middle of my broadcast. Everybody knows we're on noon on Monday. That was Rock You Like a Hurricane from the Scorpions. Seems appropriate as we're trying to fade this hurricane here in central and western Florida. Welcome again to our weekly episode of Loser's Lunch, our exploration in and of excellence. Not a hell of a lot of excellence going on lately, by the way. If you look at the financial markets and the economy, as we sit here now, 381 on 10s. It's pretty much been the same story for the last, 3, 4, 5 days. Looks like we're going to sell off in the morning. We sort of get back to reasonable levels. And then as soon as we kind of cross midday, things go from bad to worse. There's just no liquidity. There's no liquidity. There aren't any buyers. At the end of the day, something has to give. And we'll see if it's going to give in the next week. I don't know. Since 1988, my 35 years in the business, I got to tell you, I don't know that I've quite seen anything like this. And here's what I mean about that. I mean, I remember sitting here at this desk, not literally, I was in New Jersey, but in front of this computer, I could say that, in front of this computer during COVID. And I remember the day that every coupon on the screen went to par. And you could sort of understand why that happened, right? I'm going to argue that this is like worse than that. I truly feel like this is worse than those early days of COVID. If you pull a chart, there is absolutely zero correlation. And this is the thing that I don't think the Fed's going to understand. Because all they want to look at is their data, and figures lie and liars figure, as we're now at 383, by the way. Crazy. Where are stocks? Stocks, I guess, are about flat, but I'm not necessarily looking real time. What the Fed doesn't understand, and let's talk about, if you want to ask the question, why are mortgage rates as high as they are right now, and about 30 seconds away from going even higher, you just shake your head at this. On the screen, what we call a jumbo 5.5, that's a Ginnie Mae 2 5.5, is 99.13 by 99.27. So first of all, that's 14 ticks wide. Let's forget about that, though. What does 99.13 mean? Well, I'm going to give you some context. July 8th, 2010, and anybody that was in the business in 2010, January 8th, 2010. Anybody that was in the business in 2010 knows that rates were high back then. Well, that 5.5 coupon was trading at 105 and change, about 6 points better than it's trading right now. You fast forward to August of 2011. Also, interest rates at that point started to get better, but weren't necessarily great. That coupon was trading at over 111, 12 points more. The last time the 10-year was above 3.5 round numbers, and this is a moving target, minute to minute, day to day, hour to hour, week to week. But let's just call it like a low point on a 5.5 coupon was at 107.31 ish. Arguably at 111. Could have been at 110. If you remember early 2014 after the taper. So let's talk about the taper tantrum of 2013. 9/5/2013, 108.3. Inexplicable. On January 16th, 2020, we were at 104.17. On 4/14/20, we were at 106.14. Just to give you some numbers. In the last year, if you just do this year, the chart for this year, so let's talk about support. We're showing 99 on 4/28. So we're getting there. Anyway, so what do we got? This week, we got durables tomorrow, bunch of housing, Case-Shiller, FHFA. We got consumer confidence, Richmond Fed. Wednesday, some more pending home sales, some gas stuff. Thursday, we have final print of GDP. I know that I keep reading headlines that we're heading into a recession. Newsflash. On Thursday, September 29th, if this prints negative, and we're expecting negative 0.6, the last revision was negative 0.6, we are officially in a recession as of 8:30 on Thursday, if this number prints negative. Why? Because the historical definition of a recession is 2 negative quarters. Anyway, Friday we got PCE. That used to be the Fed's preferred measure of inflation. They talked about it in Jackson Hole. We continue to worry about PPI and CPI. Let's see what happens. We're expecting a year-over-year of 6.3, a month-over-month of negative 0.1. We're expecting the core number to print at 0.5. We're expecting the core year-over-year to print at 4.7. We're also expecting personal income at 0.3 in Chicago, PMI at 51.8. Sentiment also comes out on Friday. Next week, we got ISM Manufacturing on Monday. We're expecting prices paid of 55 and the headline of 52.8. Keep in mind, folks, anything under 50 is contraction. We did not print contractionary ISM numbers in the previous 2 quarters that resulted in a negative GDP. We got ADP on Wednesday, and we're expecting 288. Maybe that's the report that misses, because previous was 132. ISM Services is supposed to dip below 60 for what I have to imagine is the first time in a while. I don't have a chart on that, but at 57, that's what we're expecting. The PMI number to be 56, which would be in line with last month. And then jobs. Non-farm payroll, we're expecting 250. Will we get a downward revision from last month? earnings expected at 0.3. Unemployment rate expected at 3.7. So we got some Fed speak. Bostic not fully pulled the reins in on the economy. Action of global central banks not as uncoordinated as some might think. Events in UK don't help outlook for possible recession, rising uncertainty. The question is how events in the UK might weaken the European economy. I don't know what any of this means, folks. Ask real people on the streets. And they'll tell you that stuff's getting real out there. So we'll see. If you have any thoughts on what you're seeing, on what your buyers, your realtors, your local businesses are seeing, drop a line. Would be curious. You know, everything that I'm being told, folks are saying that stuff is getting bad. So what do you do? Here's the flip side. I keep hearing that there's been a capitulation on the part of home buyers, you know, to really not care about interest rates. I'm hearing that realtors are, you know, simply looking to get deals done, whatever it takes. So in some respects, I'm hearing that business is getting easier. I know that you don't like to talk on camera, Jenna, but I'm going to put you on the spot because you spend time, you know, time in both Florida, New Jersey, Philly. What are you seeing out there when you go to a restaurant, when you go to a store? Just out of curiosity. You're not going to leave me hanging, are you? She hates. It's full. Can't get into a lot of places. Restaurants you're talking about? So let me ask you a question. Are they trying to fill all of the tables? Like here in Florida, it's full, right? But they're only seating half the tables. Are they seating all the tables where you are?
Yeah, you can't get in to any, you can't get in anywhere in New Jersey, in at the shore. I mean, it's booked solid even now.
Interesting. And people have to eat. So here's for me our mindset, my mindset, the mindset of many of the folks that I have one-on-ones with on a weekly basis, is that there's opportunity out there, that there seems to be a fair amount of M&A opportunity. I'd be curious for those of you that are going out to aim fuse, which it looks like because of the hurricane, we'll be heading out early on. Excuse me. there's going to be some real M&A opportunity. Be curious to see what sort of conversation exists out there on that. That's number one. Number two is, what is the trajectory of housing here over the next 30, 60 days based on this Fed speak? And there, by the way, there's a lot of ECB and Fed speak this week. What happens there? Are we going to touch 4%? By the way, twos are at 428.5 right now. We had a full inversion at some point. Threes are actually yielding 433, so they're slightly above twos. But the 30s are yielding 366. Tens are yielding 382. Part of the reason why mortgages are getting hurt, folks, and because the inversion is as steep as it is, I think it's as steep as it's been since 1981. The duration on mortgages is shorter than you think. So we're getting hit more by the short end than we are by the, because you turn around and say, well, 30-year mortgage, if a 30-year bond is at 366, how could a 30-year mortgage be at 7%? And that's a very fair question to ask, right? Because if you just purely look at it from the lens of an investor, if I've got a dollar to invest in bonds, why would I ever buy a 30-year bond at 366 versus a mortgage at 7, let's just say? My short answer is I wouldn't. Okay. I mean, for the record, the idea that a 30-year U.S. bond is any safer than a 30-year Ginnie Mae, I sort of call bullshit on that, incrementally and anecdotally. At the end of the day, if this goes into a big multi-issuer pool where you have, thousands and thousands and tens of thousands and hundreds of thousands of mortgages underlying in that bond, the idea that that bond would fail. And then when it does, you have guarantees on that bond. I don't know that justifies taking 3%, 4% less in yield. So at some point, you got to imagine that there's a market for some of this stuff. Certainly yielding better than stocks right now. Would you rather earn 7% on a Ginnie Mae bond or be in stocks right now? So interesting stuff. One of the things I was discussing with Neil Ross this morning is, I think part of the reason why borrowers are tired of talking about rates and don't care about rates anymore is, let's be honest. Does anybody think that any loans that are being funded in the second half of 22 aren't going to be refinanced in 23? I mean, so who cares? To me, the question is, and this is the question I'd be asking as an LO, if a borrower, was pushing back on, 6 and 7% interest rates, is very simply this statement. And these aren't scientific numbers, but let's just say it's an extra $50 a month, $20 a month, $100 a month, whatever the number is. And I'm using 6 to 18 months as my window for refinancing that business. Can you afford an extra $120? Can you afford an extra $1,800? Because if the answer is you can, then this really is irrelevant. What we should be doing is sort of pricing in minimal fees and getting ready to refinance everybody when the bottom falls out. I read an interesting post that said something along the lines of, the Fed only knows, I should say, 90 miles an hour or jam on the brakes. And that's what we're seeing here, folks. So on that note, as I continue to say in my mortgage minute, your best practice here is to lock on a day-to-day basis and not look back. If you're talking about December and January and February and maybe even late November fundings, those are probably afloat. Hard to envision that it can get much worse from here. That being said, I probably felt that 3 weeks ago as well. So, that is where things stand. So for those of you going out to Fuse, God willing, I will see you there. Otherwise, keep rocking out. Drop me a line with some feedback on what you're seeing. Choo-choo.